Bitcoin arrived with a promise that sounded almost revolutionary. A world where money could exist without banks, governments, or the hidden power of central authorities controlling the system. For many people, it felt like the beginning of financial freedom, a chance to escape a system that printed money endlessly while ordinary savings slowly lost value. But history carries a warning that every generation eventually learns. Freedom sounds powerful, but when rules disappear, chaos often follows close behind. To understand why Bitcoin captured the world's imagination, we have to return to one of the most dramatic financial crises in modern history. The year was 2008, and the global financial system was beginning to crack under the weight of its own risks. Banks had spent years building a fragile empire of debt, speculation, and complex financial instruments that very few people truly understood. When the investment bank Lehman Brothers collapsed, the shockwaves spread through every corner of the global economy. Suddenly, something deeper broke along with the markets: public trust in the financial system itself. Governments responded by printing trillions of dollars to stabilize the system and rescue major financial institutions. But for millions of ordinary families, the outcome looked very different. Homes were lost, jobs disappeared, and lifelong savings vanished. In the middle of this global crisis, a quiet message appeared online in a small cryptography mailing list. The message came from someone using a name no one had ever heard before: Satoshi Nakamoto. Attached to the message was a short document, just 9 pages, that would eventually change the conversation about money forever. Inside those pages was a radical idea: a currency that could exist entirely without banks or governments. Transactions would be verified by cryptography instead of institutions, recorded forever on a public digital ledger. And the total supply would never exceed 21 million coins, creating digital scarcity for the first time in history. In 2009, the system quietly came to life when the first block of the Bitcoin blockchain was mined. Hidden inside that first block was a newspaper headline about bank bailouts, a permanent message frozen inside the code. Bitcoin mining had nothing to do with digging in the ground. Instead, powerful computers competed to solve complex mathematical puzzles. Thousands of machines across the world raced every second, forming a decentralized network unlike anything finance had ever seen. In the beginning, Bitcoin had almost no value. People traded it casually on internet forums, experimenting with a strange digital currency few believed would ever matter. To most outsiders, Bitcoin looked like nothing more than a curious experiment created by programmers and cryptography enthusiasts. But in 2010, something small happened that would later become legendary in the history of cryptocurrency. A programmer decided to buy 2 pizzas using Bitcoin, offering 10,000 coins for the delivery. At the time, it seemed like a fun experiment, just a quirky moment in a tiny online community. Today, those 2 pizzas would be worth hundreds of millions of dollars, making them the most expensive meal in financial history. As stories like this spread, more people began paying attention to Bitcoin and its strange new financial experiment. By 2013, Bitcoin's price had exploded from less than $1 to over $1,000. Investors, speculators, and curious newcomers rushed into the market, hoping to catch the next financial revolution. New cryptocurrency exchanges appeared almost overnight, promising easy access to this rapidly growing digital gold rush. The largest of these exchanges was called Mt. Gox, and at one point it handled the majority of Bitcoin trades worldwide. For a moment, it felt like Bitcoin had finally become a legitimate global financial system. But behind the scenes, serious problems were quietly building inside the exchange. In 2014, the nightmare arrived. Mt. Gox suddenly halted withdrawals. Soon after, the company announced that hundreds of thousands of Bitcoins had disappeared. Roughly 850,000 coins were gone, worth hundreds of millions of dollars at the time. It was one of the largest financial losses in the short history of cryptocurrency. Victims searched desperately for answers, but there was no authority to call, no regulator to investigate, and no insurance to cover the loss. The blockchain showed every transaction clearly, but it could not reverse them. For many people, it was the first painful lesson of decentralized finance. The system had no middlemen, but it also had no safety nets. After the Mt. Gox collapse, many believed Bitcoin would disappear forever. But something surprising happened. Instead of dying, Bitcoin slowly rebuilt trust through the very thing that made it unique. The blockchain never stopped working. Block after block, the network continued running exactly as designed. For some believers, this was proof that the system was stronger than any single company. But the cryptocurrency world was far from safe. New scams, hacks, and fraud schemes began appearing across the rapidly expanding crypto ecosystem. Billions of dollars vanished through exchange hacks, rug pulls, and elaborate investment fraud. In just one recent year alone, criminals stole more than $3.8 billion from crypto platforms. The lesson was becoming painfully clear. In decentralized finance, security was entirely the user's responsibility. This is why experienced investors began moving their coins into hardware wallets. Cold storage meant one simple thing. If you controlled the private keys, you controlled the money. And that idea was revolutionary. For the first time in history, individuals could store wealth without banks. This promise of financial freedom attracted millions of new users around the world. But it also attracted governments, regulators, and politicians who began watching the industry closely. Because when money changes, power often changes with it. Some governments resisted cryptocurrency entirely. Others chose a very different path. In 2021, El Salvador made history by adopting Bitcoin as legal tender. For the first time, a nation placed its trust in a decentralized digital currency. Supporters called it the future of finance. Critics warned it could become a dangerous financial gamble. As Bitcoin grew, another pattern emerged that few had predicted. A tiny number of wallets now controlled a huge portion of the total supply. Power, it seemed, had not disappeared. It had simply changed shape. These giant holders, known as whales, could move markets with a single transaction. When they acted, prices soared or crashed, and the rest of the world had no choice but to follow. It was power hidden in code, invisible yet undeniable. Politics entered the fray. Some leaders embraced cryptocurrency, praising innovation and freedom, while others warned of instability, cautioning that the stakes were far higher than anyone imagined. Despite all this chaos, Bitcoin remained strong. Its code stayed pure, its blockchain secure, a testament to the technology itself, even as human greed and folly swirled around it. Bitcoin's creator is unknown. Satoshi Nakamoto vanished, leaving money beyond governments. But human nature stayed the same. Bitcoin's story is about more than money. It's about power, freedom, responsibility, and ambition. Even in a world without states, influence finds a way.